Hi, in this video, we will summarize the standard IAS 2 inventories. Welcome. I'm Sylvia, the founder of IFRS Box, the place to be if you want to learn and understand IFRS easily. I have created the IFRS Kit, my premium course full of videos, Excel files, examples, and other useful materials, so check that out at ifrsbox.com if you need to. Let's focus on IAS 2 now. Accounting for inventories is arranged by the standard IAS 2 inventories, as we have already said, and that's one of the older standards as it was issued in 2003 in more or less current form. IAS 2 defines inventories as assets that are either held for sale in the ordinary course of business, so no, if you occasionally sell some piece of your property, plant and equipment, some machine or a car, it would not belong to inventories because occasional sale is not in the ordinary course of business. Then inventories are assets in the process of production for such a sale, and inventories are also assets in the form of materials or supplies to be consumed in the production process or in the rendering of services. So in classifying your inventories, you should focus on their purpose. What can you consider inventories? What are the examples of inventories? Merchandise or goods purchased and held for resale, for example, in the supermarket. Production supplies, for example, some petrol, oils, or anything used in the production process. Materials like raw materials, iron, aluminium, whatever you need. Work in progress or half semi-finished products. And of course, finished goods that you produce. For all these items, you need to apply IAS 2 inventories. How should we measure inventories? Well, the basic measurement rule is to measure inventories at lower of cost and net realizable value. There are only two exceptions or two types of inventories to which this rule does not apply. Number one, producers of agricultural or forest products, mineral and mineral products, and they measure inventories at net realizable value basically. And commodity dealers and brokers who measure their inventories at fair value less cost to sell, for example, gold, petrol, and similar. Let's take a look at the cost of inventories. It consists of three elements. Number one, cost of purchase. And here we include a purchase price, import duties, non-refundable taxes, costs directly attributable to the acquisition of finished goods like transport, and we deduct trade discounts and similar items. And next, we have costs of conversion. And these are the costs directly related to the units of production like direct materials, direct labor, and also production overheads allocated on a systematic basis. The third element is other costs, and we include any other costs into the cost of inventories only if they are incurred in bringing the inventories to their present location and condition. What should you not include? Abnormal waste of materials, labor, and other items, storage costs. But if you need to store some work in progress before further production stage, then yes, you can include these, but not other storage costs. Administrative overheads, and here general admin like accounting department, etc. It's not included. And selling costs. Then IAS 2 permits certain measurement techniques. Well, it is simply a method to approximate cost of inventories for convenience. And these techniques are used when the items are small, in large quantities, and it would be very impractical and difficult to set the unit costs. IAS 2 permits two measurement techniques. The first one is standard cost. So instead of calculating the real cost of inventories, you use the standard cost set by some calculation or cost card or something similar. And this method is mostly used by the producers of large amount of small items. The second measurement technique permitted by IAS 2 is retail method, and it is often used by the retailers who have large turnover of inventories with similar profit margins, and the cost of inventories is calculated as selling price less profit margin. Now let's talk about the cost formulas. Sometimes you buy the same inventories at different prices, and when you sell them, then you need to recognize an expense in profit or loss. How much? Well, it depends. Are your inventories not interchangeable? And also, are the goods or services produced and segregated for the specific project? If yes, well, meaning that inventories are not interchangeable or you have a specific project there, then you need to account for the expenses for inventories or cost of sales in the specific amount of costs. For example, let's say that you deal with vintage cars. Vintage cars are definitely not interchangeable. They are very specific. So if you buy a red car for 100 and you sell it later for 120, then you must recognize cost of sales of 100, which is specifically cost of that red car. If the answer is no, meaning that there's no specific project and inventories are interchangeable, you can use cost formulas. In other words, you don't have to search the specific cost of every single small little product that you sell. And instead, you can use either first in, first out or FIFO method or weighted average. If you want to know more about these methods and find some example on how to apply these methods, please visit ifrsbox.com and you'll find everything there. As I have explained, you would use cost formulas when you have lots of interchangeable items, just as an example. And let me remind you that LIFO is not permitted by IAS 2, that's last in, first out. It is permitted in US GAAP, but not in IFRS. You should use the same cost formula for all inventories with similar nature and use for the entity. Now let's take a look at net realizable value. It is estimated selling price in the ordinary course of business, less estimated cost of completion, less estimated costs necessary to make a sale. You need to make sure that inventories in your financial statements are not stated above this net realizable value. So if net realizable value is lower than cost, then you need to write down your inventories to their net realizable value. Finally, IAS 2 also prescribes when and how to recognize the inventories in the profit or loss as an expense. So when the inventories are sold, then you need to recognize the carrying amount of items sold as an expense in profit or loss. So the journal entry is to debit profit or loss, cost of sales in most cases, and credit inventories. The amount is simply the carrying amount of items sold, whether it's cost or net realizable value. When net realizable value is lower than cost, or when there is some loss on inventories, then you need to recognize it as an expense in the period when the write-down or loss occurs. And the journal entry is to debit profit or loss, write-down, or cost of sales most often. The question is whether to present it separately from cost of sales or not. The standard IAS 2 does not require it, but you should provide sufficient disclosures in the notes. Credit is inventories, possibly some allowance account. If there is a reversal of any write-down due to increase of net realizable value, then you should recognize it as a reduction in the amount of inventories recognized as an expense in the period in which the reversal occurs. The journal entry is to debit inventories or allowance account and credit profit or loss, cost of sales most often, or reversal account. So this was the basic introduction to inventories as arranged by IAS 2. And if you need to learn more about this topic and see some examples, not only on IAS 2, but also on other IFRS topics, you're very welcome to check ifrsbox.com, subscribe to my free newsletter, and learn to apply IFRS in practice. Thanks for watching. Bye.